Hello, everyone, and welcome to this quick market and economic update. Today, I want to talk about the ongoing military situation in Iran, what it could mean for markets, oil prices, and then, of course, your portfolio. Before we get into the financial side of it, we want to take a moment, pause, and acknowledge that these are very serious events. Real people are being affected, civilians in the region, members of our military. Their safety is what's most important, and I hope that we can come to a quick solution here with as minimal impact as possible. At the same time, I'm sure you guys are all wondering what it means for your financial plan and your portfolio. And, when headlines like this get intense, it can create uncertainty, and certain uncertainty often leads to a lot of questions. So we want to try our best to answer some of those for you. There's a quote from President Eisenhower that I think applies, and it says, plans are worthless, but planning is everything. So, you can't just build a plan and forget about it for 3 to 5 years. What we do here is not about one-off financial plans. It's the act of continual financial planning, and that's super important. What it means is, that we can't predict these specific events. We don't know exactly when or where they'll happen, but we do know that events like this are definitely going to happen. Uncertainty is usual, and it is always constant. That's why our goal isn't to build a portfolio around any specific event, but have a well-constructed portfolio and financial plan that's designed to hold up through any of these type of environments or events. But let's take a look at a few items and put the developments that we're seeing into perspective and walk through what long-term investors should keep in mind here. So first, while the scale of the current strikes is significant, it's helpful to zoom out a little bit. Tension between the U.S., Israel, Iran, didn't just happen overnight. There's been some building going on for quite some time. The latest developments come after extended U.S. military presence in the region. People have been there for a while. There was stalled nuclear negotiations and obviously years of back and forth escalations. If you look at the broader history, there's been a long pattern of conflict in the Middle East involving the U.S. from the Gulf War to Iraq and Afghanistan, and even most recently with the conflicts in Israel with Hamas. Alongside that, there have been multiple attempts at nuclear agreements between the U.S. and Iran. Important context for investors is, geopolitical conflict, even when it feels dramatic and urgent, has not consistently led to market declines. In many cases, markets have absorbed the news fairly well, an initial downward reaction, but then, eventually cooling off and a resumption of the market climbing up. Usually these things don't have prolonged, sell-offs, and we're even kind of seeing that today. Today we opened up down quite a bit. I'm recording this on Tuesday afternoon. Market opened up down quite a bit, was able to rally most of the day. So it's really more common when these events happen than uncommon. Even oil prices, which you might expect, to react to most events like this, haven't always experienced sustained long-term spikes. They kind of go up for a short period of time and then traditionally roll over. It doesn't mean the events aren't serious. They absolutely are. But from an investment, portfolio perspective, history reminds us that making big emotional portfolio changes in response to headlines like this is rarely beneficial in the long term. Staying disciplined has tended to matter much more than reacting quickly. And you can kind of see that in this chart here, showing different environments, the spikes of crude oil prices in that gray, but the S&P 500 in the black, traditionally has been able to carry on there. So definitely important to keep the long term in perspective when the short term gets a lot of question marks put around it. Moving to the next slide here, oil for investors, that's usually the most direct way conflicts in the Middle East show up in our financial markets and everyday life is around oil. Iran sits along the Strait of Hormuz, which is a critical shipping route. Roughly a third of the world's seaborne oil passes through this tiny little waterway. So even a little bit of disruption can cause energy prices to move quite a bit. We've already seen oil prices, kind of start to tick up before the strikes, and then they've obviously continued to climb since then. That said, there's a little perspective goes a long way. Even with the recent move, they're well below the 22 peak of $128 a barrel after the Russians invaded Ukraine. Right now, we're around 70 range, very different environment than what we experienced, a few years ago with Russia and Ukraine. So a little bit more tampered in the oil department. Definitely important to remember that the U.S. became the world's largest producer of oil and natural gas in 2012. Today, we produce more than Saudi Arabia and Russia. It doesn't make us immune to what's going on around there and immune to energy shocks, but it does provide, a meaningful buffer for our economy here in the United States. You see that in the dollar. The dollar's kind of strengthened the last few days because we are net exporters of oil. We produce more than we use. And so people from around the world, might have to come to us for our oil. Causing an increase in our oil would cause a demand increase in people needing to have dollars in order to do that. So we've seen the dollar go up a little bit as well. Also, the dollar is still the reserve currency of the world. I'm not going to sit here and say, it's not under pressure in that category, but it still is. And so there's a flight to the dollar as a tendency to have a natural flight to safety as well. But if you think back to 2022, many analysts expected oil prices to stay elevated for a very long time. Instead, they stabilized and declined much sooner than most people predicted. It's a helpful reminder that markets often adjust more quickly than the headlines would suggest they're going to. So it's important to, think about, hey, what I'm reading is this person that I'm reading trying to make me feel comfortable and secure? Or are they trying to just get me to read? The headlines get very intense when the reality maybe is a little bit more muted. So definitely important to keep that in perspective. Lastly, maybe, most importantly for long-term investors, history really reinforces the value of staying invested through times like this. If you look back, markets have lived through incredibly serious global events: World War II, the Gulf War, 9/11, financial crisis. We could just go on and on and on. In many of those moments, volatility picked up in the short term, which we're seeing today. That's normal. But over time, markets have continued to be driven by the fundamentals of the, economy and obviously the companies that are involved in that economy. So always have to come back to the fundamentals from time to time as well. Earnings, innovation, productivity, growth, all of those things, in the long run always are going to win out. So it's also, worth mentioning that Iran itself plays a very, limited direct role in most investment portfolios. There are just so many sanctions and stuff that of our international investments, very little of that is going to be involved in Iran really in any way. Could we see more volatility in the days or weeks ahead? Absolutely. We don't know what's going to happen. The last I saw was we were a couple of weeks out from needing to do anything in Iran, and then within 48 hours, it was on. So, you can't really ultimately know what's happening, what the decision-making process is. So it's hard to prepare for events like this because, the timing, we're just not informed of that. But the markets don't like uncertainty, and these headlines and these price moves create a lot of uncertainty in the short run. So we do expect volatility and adjustments to that. But history tells us nothing, is going to not to jump in and jump out. It's very, very difficult to do. Timing those moves is very difficult. And the data speaks for itself. Trying to do so has usually caused much more harm than good if you're a long-term investor. Bottom line type stuff here is, a well-diversified portfolio aligned to your long-term goals, is still the most effective way to navigate periods like this. When things like unemployment or slowing earnings or things like that are starting to gradually build, you can make adjustments to your portfolio to take off risk, if you need be. When events are unpredictable and happen, in the blink of an eye like this, very hard to predict and navigate in the moment. You have to trust, your long-term plan, your long-term portfolio to get through these things. So we know, they're difficult to watch unfold. It's completely understandable to have questions. If you have any, as always, just reach out. We'll be happy to answer any of those. We'll continue to update as needed and as we get more information from our research partners like we did today. And, most importantly, look at the data. Just look at the data. The S&P 500 is down less than 3% from an all-time high, with lots of bad news going around. Obviously, the conflict in Iran, but AI eating the world and our jobs, and there's just a lot of negativity out there. The market's down less than 3% from all-time highs. So definitely keep that in perspective. So again, we appreciate you all taking the time. We hope you have a great rest of your week, and we'll talk to you all very soon.